Let me start by thanking Professor Neck and, of course, the International Atlantic Economic Society for the invitation. I can think of no more appropriate place than Vienna to discuss the business cycle views of Mises and Hayek. As many of you perhaps know, building on the work of Knut Wicksell and Eugen von Bavard, Ludwig von Mises and Friedrich Hayek developed a unique theory of the business cycle. In their view, an unsustainable boom ensues when the rate of interest prevailing in the market falls below the natural rate. Mistaking this easy credit for a genuine increase in savings, entrepreneurs are led to take on more capital-intensive projects, and according to the Austrians, the boom is characterized not only by an increase in aggregate production, but also by a distortion of the structure of production. Once the errors are realized, a recession follows, so aggregate production declines while the structure of production is repaired. Hence, the Austrian account of macroeconomic fluctuation stresses the misallocation and reallocation of resources in addition to the overproduction and underproduction of more conventional business cycle theories. Now, assessing the empirical relevance of the Mises-Hayek theory of the trade cycle has proved difficult with the available data. As Ed and I, as our former professor Pete Betke likes to remark, statistics are not collected as brute facts. Data is informed by theory. And in the post-war period, the macroeconomic data was collected to answer a particular set of questions, what we might call Keynesian questions. And so in some sense, the data that's collected is Keynesian data. As a result, it doesn't lend itself to considerations of the disaggregated view of Mises and Hayek. So many self-ascribed Austrians have dealt with this by employing unconventional data or unconventional empirical techniques. And some Austrians, as one gentleman remarked in the earlier lecture, have not considered the empirical relevance of the Austrian business cycle theory altogether because of this problem. Now, in a recent article, Robert Lester and Jonathan Wolff, they use conventional data and conventional empirical techniques to consider the Austrian business cycle theory. The authors measure the structure of production with stage of process data. Then, using a structural vector autoregression, they estimate the change in production and prices immediately following a monetary shock. Their results call into question the Austrian view. They find that monetary shocks are associated with an increase in aggregate production, but the magnitude of changes in the structure of production are small, statistically insignificant, and often of the opposite sign predicted by theory. Now, I should say that my co-author, Mark Cohen, and I were very supportive of Lester and Wolff's efforts to consider the empirical relevance of the Mises-Hayek theory of the trade cycle. But we take issue with their use of the federal funds rate as a stance for monetary policy. So what we want to do in our paper is improve upon their analysis by using a measure of the stance of monetary policy that's more consistent with the Austrian view. So in what follows, I'll briefly review the theory of the Austrian business cycle theory, and then discuss the data that we use, the empirical technique, and then finally the results. Roger Garrison presents the Austrian business cycle theory with a very simple three-quadrant model. In our bottom left-hand corner here, you can see the market for loanable funds. The interest rate that clears that market is what we would call the natural rate. In the upper right quadrant, you can see the production possibilities frontier. It's worth noting that this is a sustainable production possibilities frontier, so it doesn't illustrate the technical possibilities of the economy, but rather the combinations of consumption and investment that are possible with full information and utility maximization. And so it's analogous to the long-run aggregate supply curve in more conventional business cycle theories. And as in much the same way, the economy can move beyond the production possibilities frontier, or what we might think of as overproduction. It may be within the production possibility frontier, what we might think of as underproduction. You'll also note that along the vertical axis, the investment that you get is equal to the quantity of loanable funds in equilibrium in the market for loanable funds. And so we can see that the natural rate of interest corresponds to the natural level of output, a point along the production possibilities frontier. And so shifts in the supply or demand for loanable funds is going to result in movement along the production possibilities frontier. The left quadrant, which is often referred to as the Hayekian triangle, named after F.A. Hayek, of course, is the uniquely Austrian component of the Austrian business cycle theory. Along the horizontal axis, we're measuring time, the length of time of the representative production process takes. Production furthest to the left is going to represent the early stages of production. The output of those early stages of production are going to feed into they'll be the inputs for the intermediate stages of production, which will be the inputs to the later stages of production, the final stages of production. And the height of the Hayekian triangle, that's going to correspond to the value of production in the various stages. You'll notice that along the far right there, the height of the Hayekian triangle corresponds to the amount of consumption, because the height of the triangle at the far right is final goods and services produced, the value of final goods and services produced. Now, from this initial equilibrium point, we can consider what would happen if there were an increase in, say, the growth rate of money, as envisioned by Hayek or Mises. Perhaps we can, there we go. And so we can see that an increase in this expansionary money causes what appears to be a shift in the supply of loanable funds. Of course, this isn't a genuine increase in the supply of loanable funds. There hasn't been a change in, say, savers' desires to save. Rather, it appears as if there's been an increase in the supply of loanable funds because of the money that's papering over the gap. And so as a result, the interest rate, the market rate, falls below the natural rate. And this creates what Garrison describes as a double disequilibrium. Savers want to save less, while borrowers want to borrow more. And we can see this also in the production possibilities frontier, where savers saving less means consumers are consuming more, investors are investing more because borrowers are borrowing more. And so we have this tension. We're pooling at both sides, and that combination pushes us beyond the production possibilities frontier. In other words, we have overconsumption, overinvestment, overproduction. Now, so far this may sound familiar. We have what we might call an increase in nominal spending. Individuals are fooled into overproducing. And so this sounds a lot like perhaps a new Keynesian view of the business cycle. The uniquely Austrian characteristic, though, is in this third quadrant, the upper left. The lower interest rate, the artificially low interest rate, sends two distinct signals to entrepreneurs. On the one hand, it tells them to produce more consumption goods, more final goods. We can see that by the curve shifting up. This is called the derived demand effect. On the other hand, the interest rates are lower. Those induce entrepreneurs to increase early stage production as well via the time discount effect. And so again, we can see that two sides pulling against the middle, both over consumption and over investment. But the unique contribution of the Austrian school is that we're getting what the Austrians refer to as malinvestment. Malinvestment because the structure of production is being distorted. Now, as we move forward, there are two things you'll want to keep in mind. First, monetary expansion results or is characterized by the market rate of interest being below the natural rate of interest. And second, that in addition to overproduction, overconsumption, and overinvestment, the Austrians are going to stress that there's this distortion of the structure of production. And in particular, early stage and late stage production are going to increase relative to intermediate stage production. So that's a unique prediction of the Austrian view that you don't find in more conventional presentations of business cycle theory. Okay, so I mentioned earlier that our principal complaint with the earlier study was their use of the federal funds rate as a gauge of the stance of monetary policy. And so let me just consider two cases here to show why that's problematic. So we can think of two cases where the federal funds rate would fall. The first would be an increase in the supply of loanable funds. Both the federal funds rate and the market clearing rate would fall in that case. So the natural rate as well would fall. And so we might say that the federal funds rate is low. It's certainly lower than it was. And as a result of this, savers are going to save more and borrowers are going to borrow more. So there's no tension there. We're going to move along the production possibilities frontier. The structure of production is going to alter. We're going to get more early stage production and less late stage production initially until there's additional growth from that, from those investments. The federal funds rate again would fall, but the natural rate is unchanged, right? The rate that would clear the market for the loanable funds hasn't changed. And so it's not just the case that the federal funds rate is low, it's that it's too low. It's that it's artificially low. It's that it's lower than the natural rate. And this is what the Austrians are pointing to that would distort the structure of production. And so whereas before we saw early stage production increase while late stage production decreases, now we have this tension, both sides pulling against the middle. Both early and late stage production increase relative to intermediate stage production. Now I should say that noting that there's this relative increase in early and late stage production does not imply that intermediate production is contracting. It just implies that it's not increasing as significantly as early and late stage production. So this suggests that that the use of just looking at the federal funds rate is problematic because it doesn't distinguish between a rate that's low or high from a rate that's too low or too high. There's a rate that's departing from the natural rate. And so this is the principal problem we want to deal with in the study by Robert Lester and Jonathan Wolfe. And so to start, we're going to need to have some estimate of the natural rate. In order to gauge the stance of monetary policy, we're going to need an estimate of the natural rate. And so we use the productivity rule that was estimated by George Selgin and David Beckworth. They derive the natural rate, they derive that as a log linear function of the time preference, productivity growth, and labor input growth rates. Then, assuming that time preference is unchanged and labor input growth rates are constant, they're able to estimate the natural rate using total factor productivity data. I'd be happy to speak more about that in the Q&A if you're interested. So with the measure of the natural rate, then we take a measure of the market rate, and since we're trying to come as close to the earlier study as possible, we use the federal funds rate. And then gauging the stance of monetary policy from an Austrian perspective, we take the difference between the federal funds rate and this productivity rule. I should mention that since the productivity rule is only affected by changes in total factor productivity, Selgin and Beckworth refer to this as the productivity gap, comparable to, say, a Taylor gap, an output gap. Okay, so now that we have a measure of the stance of monetary policy, let's look at the stage of process data that we'll be using. Industrial production data comes from the Federal Reserve. They produce this stage of process data that's based on 312 individual series. It measures real output of domestic manufacturing, mining, electric, and gas utilities. And they divide these into 4 stages: crude, primary, semi-finished, and finished. And so we take the crude to be the early stages of production, primary to be the intermediate stages of production, and finished to be the late stages of production. And I should say that this choice between primary and semi-finished turns out to be pretty arbitrary. We've looked at it both ways, and it doesn't make a meaningful difference. For prices, we use the Producer Price Index from the Bureau of Labor Statistics, and they similarly offer this stage of process data. They have 3 categories: crude materials, intermediate materials, and finished materials. Let me say a bit about each of those. The crude materials, those refer to products that have not been manufactured or fabricated and are not sold directly to consumers, those are classified as crude materials. Products that have been manufactured or fabricated but either require further processing or are purchased by firms as inputs are classified as intermediate materials. And finally, products that are ready to sell are classified as finished materials. Now, since the Austrian view looks at the relative change in the early, intermediate, and final stages of products and production and prices, we create these ratios. So our ratio of early to intermediate production is the crude to primary. Our ratio of late to intermediate is the finished to primary. Similarly with the price index, it'll be crude to intermediate and finished to intermediate. Let me say a few quick words about our technique. We use a structural vector autoregression. It's a 5-variable system with 12 lags. It's a structural variable, so we have to provide some structure. And in particular, what we do is, as is common in macroeconometric studies like this, we structure the model such that monetary policy does not have contemporaneous effects on the ratios of industrial production and prices. Okay, so let's go ahead and turn to the results. Here are our impulse response functions. The impulse is a 100 basis point increase in expansion in the productivity gap. And so what we would expect to see if the Austrian business cycle theory is empirically relevant is all of these cumulative response functions increasing, right? Because the first is early to intermediate stage price levels. The second is late to intermediate stage price levels. So we would, the theory would expect that those prices are going to be bid up. Similarly, the theory suggests that early to intermediate stage production and late to intermediate stage production would be increasing as the structure of production is altered. But what we see here actually is not that. We see that the results are statistically insignificant and not very big. And in fact, if we compare this to the earlier Lester and Wolf study, we see that the results are quite similar, even though we use a different measure for the stance of monetary policy. The implications, well, we find no support for the uniquely Austrian claims. I should say in running just vector autoregressions on all of the variables as opposed to the ratios, we see that aggregate production increases. It's just that the intermediate production is increasing more than the early and late stage. And so there are two potential explanations. The first is perhaps the stage of process data doesn't correspond to the structure of production. It's not clear that an increase in roundabout production means that there'll be more production of crude goods. And so perhaps the structure of production is increasing, and just the way we collect those variables is classifying those as semi-primary. The other explanation is that the structure of production is not so sensitive to short-term interest rate disturbances like the Austrians have typically claimed. This, of course, would not imply that the Austrians have nothing important to say. There may be a role for concepts like malinvestment. Indeed, we see similar concepts in considerations of the labor market when we think about the search frictions following booms or busts. And so we may still have a useful place for the concept of malinvestment broadly considered. It just might not work through this same channel that Mises and Hayek had in mind. Thank you very much.